Yields say that U.S. growth is set to slow. Equities say otherwise. Who's right? Hi, I'm Jim Griffin of Derivative Logic, here to get you straight to smart. Nominal GDP growth, the next measure of which is released this week, could come in near 17% year over year, while the 10-year Treasury yield hovers just above 1%. That huge gap is probably a record, and one that will have to be rectified over the coming months, most likely in the form of lower economic growth and a gradual rise over many months in interest rates. The message we're getting from markets over recent days is that uncertainty and volatility are on the rise, and being driven there by the red-hot inflation debate, lofty stock valuations, and increasingly gloomy public health trend, all amid growing questions about whether any meaningful fiscal infrastructure plan will ever make it through Congress. That's definitely a diverse cocktail of influencers, and markets are struggling to figure out what it all means. One piece of news that will help clear the muddy waters, though, was the Congressional Budget Office's forecast that America's output gap, that is, the difference between the economy's actual and potential production, will be eliminated by the end of this year. It's a signal that peak post-pandemic growth is likely upon us, and that it will likely moderate near year's end, squashing inflation fears with it. If the scenario comes to fruition, the Fed, by opting to keep the stimulus pedal to the metal and claiming that inflation is transitory, will look like a genius. Only time will tell. For the week ahead, the Fed's monetary policy meeting on Wednesday takes the spotlight. No one expects the Fed to adjust either of its policy levers at this meeting. Instead, given the growing signals that America's post-pandemic recovery will be a turbulent one, we expect Fed officials to focus on beginning to determine how they'll mechanically activate a taper when they deem the time is right for one, likely in early 2022 in our view. Read the full text of this week's Straight to Smart for a full analysis of what this could mean for interest rates. From all of us at Derivative Logic, have a great week.